If I told you to prioritize any chapter from this entire North Carolina real estate exam, it would be this chapter, Chapter 11. Welcome to the most important chapter, in my opinion, on this entire North Carolina real estate exam. This one is on finance and there will be several questions from it. We are over halfway done with these practice questions, so let me just reintroduce myself real quick. I'm Sean Kelly. I've worked in the mortgage industry. I'm a real estate investor. I'm a real estate broker. I remodel. I own a couple of Airbnb properties. I run 2 YouTube channels based around real estate and just a general nerd for the entire industry. I would never encourage you to procrastinate and put off studying, but if you're interested in watching videos on a cabin I just flipped up here in Beach Mountain, North Carolina, check out the video linked right up here in the corner. Anyway, chapter 11 is pretty rough, so I just wanted to start off a little lighter. If you want the full review, click on the video linked also right up here in the corner and down in the description of this video. You'll also find a 10% off link for real estate classes down there. Subscribe, hit the like button, and let's go. Question 1. Which of the following statements regarding adjustable rate mortgages, or ARMs, are correct? The interest rate changes according to changes in selected indexes. Adjustable rate mortgages always contain a due on sale clause and a prepayment penalty. All adjustable rate mortgages have a conversion feature that allows them to be converted to a fixed rate. Or D, none of the above. So the answer right here is in the name, adjustable rate. This is where the rate can adjust and doesn't stay the same, right? So like a typical conventional loan has a fixed, like usually 3% interest rate or something like that right now in today's market. And it doesn't ever change unless you refinance. So if you have a 30-year term, that rate stays the same for all 30 years, 360 months. So answer here is A, interest rate changes according to changes in selected indexes, or index. Question 2. ECOA requires lenders to make consumer loans without regard to all of the following except age, occupation, sex, or marital status. So this ties into a later chapter a little more around fair housing. Age, sex, and marital status are all protected classes and you should not discriminate. So occupation, though, is obviously one that a lender needs to take into consideration. You do need like a stable job, things like that. And how much do you make? But the answer here in this case is B, occupation. Question 3. Which of the following is not a right given to lenders by a deed of trust? Assignment, possession after default, foreclosure, or equity of redemption. So we could just take B and C off the list right away. Those mean essentially the same thing. The lender in North Carolina can get possession if you default on your loan through a process called foreclosure. So these are lenders' rights. A is assignment, which is the transfer of legal rights from one party to another. Lenders have this right as well. Equity of redemption is the answer because D is the answer because that's a right given to a borrower. Borrower can use other funds to pay off a mortgage in default and keep the property. It's a borrower's thing, not a lender's thing. Question 4. The clause that makes a mortgage unassumable is which of the following? Defeasance, alienation, mortgaging, or prepayment. So an assumable mortgage is one that does not contain an alienation clause. This clause allows the lender to declare the balance debt due when the borrower ends up selling. So if the mortgage is unassumable, then it does not have an alienation clause, right? So B here is the answer. Question 5. Which of the following statements concerning a mortgage is correct? The purpose of a mortgage is to secure the payment of a promissory note. The delivery of a mortgage is a conditional conveyance of title. C, a mortgage is a 3-party instrument. Or D, the mortgage lender is called the mortgager. So, promissory note in the answer. A should trigger this one for you right out the gate. A promissory note is a promise to pay debt as set forth in writing. The actual definition of mortgage is a written instrument used to pledge a title to real property to secure the payment of a promissory note. Answer here is A. Question 6. Which of the following is paid first from the proceeds of a foreclosure sale? Mortgage debt, real property taxes, or mortgagee's equity, or sales expenses. So let's break down the order here real quick. You have the sale of the house at the steps of the courthouse, right? Then the cost of the sale is subtracted. then old taxes, then the first mortgage, and then any second mortgages that you may have. So D, sales expenses, is the answer. Cost of sale as the expense, the cost it takes to get to that courthouse and go through that sales process. Question 6.2. If you, a future agent, decide to affiliate with Keller Williams, who are you going to put down as your sponsor? Kelly's Take, your branch manager that you interview with, I'm not sure how to pronounce that name, or Sean Kelly. So this is an extremely important question for my business, right? If you end up joining Keller Williams, which I would highly recommend you at least going and interviewing with the nearest firm with you, I would greatly appreciate it if you put me down as a sponsor, and it does a great deal for my business. I have a few people who have signed up through this channel already, and it's been great. It can also be really cool referral partners no matter where you are in the US. My name spelling is D, Sean Kelly, Shaun, and I'm in the Mooresville, North Carolina branch. I'll see you around. Question 7. What is the purpose of FHA program? Did I just blink with both eyes? Let's see. Question 7. What is the purpose of FHA programs? Making housing loans, guaranteeing housing loans, purchasing housing loans, or D, insuring housing loans. So I deal with FHA loans all the time, and this still isn't really the way I look at FHA loans, so I think this is a little tricky. But FHA programs are where people can buy a primary home to live in for way less than that 20% down, typically 3.5% down. So a conventional loan is usually 20% down. So it's only a little bit that you need to bring to the table for your first primary house. So with these, they are insured by the FHA, and they are the ones that set the standards. D is the answer. Question 8. Which of the following gives a borrower the right to pay a debt in full and remove the mortgage lien at any time after default and prior to foreclosure? Defeasance, prepayment, equity of redemption, or foreclosure. So prepayment and foreclosure should be crossed off immediately here. Prepayment doesn't make sense if you're already after default. How are you going to pay ahead if you're behind, right? Defeasance is also something that happens prior to defaulting. So equity of redemption is the answer, C. Question 9. A deficiency judgment is available to which of the following? Mortgagee, mortgagor, trustee, or trustor. A deficiency judgment is obtained by a lender for the difference between the amount of foreclosure sale proceeds and the amount needed to satisfy the mortgage debt. You can actually get this answer without knowing that definition at all. Borrowers are mortgagors. Lenders are mortgagees. A is the answer. Question 10. A deed in lieu of foreclosure conveys a title to which of the following? A lender, a borrower, a trustee, or a mortgager. So a deed in lieu of foreclosure comes from a borrower that's in default and to a lender. A is the answer here. Question 11. The type of mortgage requiring the borrower to pay only interest during the mortgage term is which of the following? Balloon, open-end, term, or closed. This is a keyword here, but also the only valid option on the list here. A term loan, C, is the answer. Balloon is where it goes and goes and goes until it pops at the end and you drop a big lump sum at the end. Term is the answer, C. Question 12. Which of the following is a mortgage given by the buyer to the seller to secure payment of part of the purchase price? Purchase money mortgage, earnest money mortgage, participation mortgage, or graduated payment mortgage. So this is a tricky way of talking about a seller financing situation here. They could have worded that way easier. Okay, so first of all, only a couple of these are keywords anyway, so you can cross the others off. But a graduated payment is where you pay lower in the earlier years, right? And then more later as you go on. But that all goes to a lender. The purchase money mortgage, A, is the answer here. Question 13. What is the amount of interest paid on an amortizing mortgage at an annual rate of 12% for a month in which the principal balance is $73,000? $600, $730, $876, or $1,369? So this is actually a really simple math problem here. The annual rate of 12%, so 12% of $73,000 is $8,760, right? But that's annual, right? Yearly. We need monthly, so we just divide that by 12, and that gives you $730. The answer here is B. Question 14. A property has recently sold for $173,000 and the appraisal indicates an appraised value of $172,000. The lender agrees to make an 80% loan-to-value loan at 5.75% interest. Assuming the investor demands a 6.38% yield, what would be the total amount collected for points at the closing? Wow, so there's a lot of random numbers in there. Just know LTV is the loan to value ratio, right? The loan to value. So take the 80% of the value, which is the $172,000 right there. It's not what it was sold for. And that'll give you the $137,600. I'm not even going to pretend like I know this answer, actually. Sorry, y'all. Remember that an eighth of a percentage of interest is a point, but the answer here is D, 6,880. You'll never, ever, ever use this in real life, but you do need to know your points, like your loan points, right? It's 1% of the loan amount will give you an eighth of the interest off of there. Just keep all that in mind, but yeah, I don't know. This is beyond me. Question 15. Which of the following... that sucks. On the most important chapter, I wish I can give you all a little bit more there. Question 15. Which of the following are not considered to be one of the 6 elements of a loan application? Marital status, social security number of the applicant, the property address, or the estimate of property value. So here are the 6 points, and see which one is not on this, right? Here's the 6 elements. You need someone's name, you need their income, their social security number, the address, the estimate of value, and the mortgage amount. Marital status is not one of the 6. A is the answer. Question 16. All of the following statements are applicable to real estate promissory notes except they must be written, the borrower is personally liable for payment, they must provide evidence of a valid debt, or they must be executed by the lender. So a promissory note is a promise to pay back the money, as we went through in a previous question. Only the borrower signs the note. This is not something that is executed by the lender. The answer here is D. Question 17. All of the following statements about FHA and VA loans are correct, except they are assumable, they require a prepayment penalty, the maximum term is 30 years, they require an escrow account. So A and B are nearly opposite, so one of those has to be the answer, right? Assumable is essentially when someone can take over the payments. B, prepayment is paying early. So B, prepayment penalty is the answer. It's completely okay to tackle your payments ahead of time in most situations. It's very rare that you'll have prepayment penalties with any type of loan. Question 18. The activity of lending institutions making mortgage loans directly to individual borrowers is a secondary mortgage market, money market, institutional market, or primary mortgage market. So when you get a loan for a house, that very first lender that you apply for, that you interview, that you talk to, they are in what market? What are they? The primary market. That's where you obtain your loan. So that's why it makes sense. That's called the primary market. Then later, they will most likely sell your loan to some other bank or some other lender in the secondary market. They're second to get that loan. It's quite simple to think of it like that. So the direct mortgage initially is D, primary mortgage market. Question 19. Which of the following is a mortgage that is not on a fully amortizing basis and therefore requires a larger final payment? Graduated mortgage, balloon mortgage, open-end mortgage, flexible mortgage. So a larger final payment. So you're paying and blowing this thing up until it pops. It's a balloon mortgage. The larger final payment is that pop of the balloon. B here is the answer. A is similar except that it's a gradual increase as your term goes on and on. Question 20. The priority of mortgages in relation to one another is based on which of the following? Time of execution, time of recording, time of delivery, or time of acknowledgement. When discussing closing on a loan in general, recording is that grand finale, right? We already touched on that a little bit. When you're at a closing table and you sign everything, it's not technically closed until it's been recorded. B is the answer. Question 21. Which of the following is a mortgage that is subordinate to another? Leasehold, blanket, junior, or participation. Leasehold is to rent, blanket is one that covers multiple items, junior, C, is the answer. And I don't know what participation mortgage is. I don't think that's a real thing. Correct me if I'm wrong. Question 22. Which of the following is a mortgage in which 2 or more parcels of land are pledged? A, blanket, B, package, C, all-inclusive, or D, junior. So follow up to the last question. Like I said, a blanket is one that covers multiple things. A is the answer. Another good example of why if you don't know an answer to a question, continue along with the test and then come back to that, because if you go back in time, you could see in the previous question, package and all-inclusive weren't even options. So there's a good chance that you could see blanket was already an answer on a previous question, or at least one of the answers available. So you could just use that to kind of guide you that blanket might be the right answer here compared to all these others. Question 23. Insurance for the protection of lending institutions making conventional loans is mutual mortgage insurance, conventional mortgage insurance, institutional insurance, or private mortgage insurance. So when you buy a house with less than 20% down, you typically have to pay PMI, and this just gives the lender an extra fee for lending you more risk, basically. PMI is private mortgage insurance. It's a very common term in the real world. I just bought another Airbnb investment with 10% down, so we'll be paying about $100 in PMI every month. D is the answer. Question 24. All of the following statements about Regulation Z are correct, except it applies to commercial mortgage loans. It requires the lenders to furnish a disclosure statement to the borrower. It provides for a 3-day right of rescission when a residence already owned is being pledged as security for a new mortgage. Or D, it regulates the advertising of credit terms of the property offered for sale. So the Regulation Z definition. Requirements issued by the Federal Reserve Board in implementing the Truth in Lending Law, or TILA, which is part of the Federal Consumer Protection Act. That didn't help at all. Regulation Z requires lenders to disclose borrowing costs so consumers can make informed decisions. It allows borrowers to shop around, and it goes for any loans. A here is the answer. It applies to commercial mortgage loans. That is not a correct answer. It applies to consumer loans too. Question 25. Which of the following statements about VA loans are correct? The repayment of a percentage of VA loans in the event of borrower default is insured to the lender. VA loans are for 100% of the lesser of property value established by the VA or the sales price. C, a veteran cannot use his VA loan entitlement more than once. Or D, a non-veteran may not assume a VA loan. I misspelled veteran, that's so disrespectful. Unlike FHA and conventional loans, VA loans can be 100% loan to value. So at a mortgage company I used to work for, we did dollar VA move-in loans, and it was you basically pay $1 out of pocket. So B is the answer here. VA loans are for 100% of the lesser of property value established by the VA or the sales price. Question 26. The major benefit of the secondary mortgage market is to reduce the effect of which of the following? Amortization, liquidity, disintermediation, expensive settlement charges. So A and B just doesn't make any sense here. D could make sense because if everything were in one single market, I could see there may be a little too much power given to, certain institutions. I don't know. But C, disintermediation is the answer. There's a definition in the book, but I'm not even going to read it because I can't interpret what that means. Question 27. The FHA bases its commitment on a percentage of which of the following? Certificate of reasonable value, purchase price, selling price, or acquisition cost or appraisal value, whichever is less. No one ever really cares about the purchase or the selling price. Let's just clear that up, right? The value comes from an appraiser, a third-party person in almost every situation. So D is the answer, the appraised value. You can overpay for something all you want. That doesn't mean that house is actually worth that much money. Question 28. Which of the following statements about discount points is correct? Each point charged increases the lender's yield on the loan by 1 percentage point. Each point charged by the lender costs 1/8 of a percentage of the loan amount. Points must be paid by buyer on conventional loans. Discount points are a form of prepaid interest. A and B are complete backwards from each other. It costs 1% of the loan amount for 1/8 of a point. Answer here is D. You basically pay 1% of the loan amount up front to reduce interest costs later on. Question 29. What is the loan to value ratio where the purchase price is $193,750? The appraised value is $182,000 and the loan amount is $155,000. So loan to value deals with value, as we said earlier. Again, no one cares about the purchase price, so cross off the $193,000 right away, right? That $193,750. $155,000, that loan amount, divided by the value, $182,350, gives you 85%. Answer is C. Question 30. Harold has purchased a property for $118,000 and plans to obtain an 85% loan-to-value mortgage. The cost to amortize the loan per $1,000 is $6.16. What will Harold's monthly P&I cost? Bunch of answers there. So, all right, what you do is you take that $118,000 and you times it by the 85% because you want 85% of what he purchased his property for to get the $100,300 loan amount. That divided by the $1,000, because it says per 1,000, is 100.3. So $6.16 times that 100.3 is $617.85. Answer there is C. Question 31. Which of the following is government-owned corporation that purchases mortgages? Fannie Mae, Ginnie Mae, Freddie Mac, or Consumer Financial Protection Bureau? So you've most likely heard of the Freddie and Fannie Mae quite a bit. These are two agencies that purchase mortgages in the secondary market. D is a made-up term, I believe, but B is the answer, Ginnie Mae. This is a government association that purchases FHA and VA loans. That's why you may not have heard of them as much. Question 32, last question. A borrower has obtained a loan for $184,300 at 5.75% interest for 30 years. If his monthly P&I, principal and interest payment, is $1,075, what would be the outstanding loan balance after the first monthly payment? What we do here, all this is simple math. You take that $184,300 and you multiply it by the interest rate, about 5.75%. What you get is $10,597 interest annually. So that divided by 12 months gives you $883.10. And we want to do months because it says, what do we do after the first monthly payment? So then that $1,075.52 minus the interest of $883.10 leaves us with $192.42 in just the principal on that first month. So that first month you pay barely any principal and then a ton of interest. So now take your entire loan amount, $184,300 minus that principal. So I have like 10 camera batteries, but of course the one that I put in my camera died on me. So I got my food while I let it charge for a bit. Go back to where we were here. Yeah, you take that $184,300 and subtract out the $192.42 to get $184,107.58 loan balance after that payment. You have your entire mortgage. You're taking out the 1 month of principal out of that amount. So B here is the answer. Chapter 11 is huge. Study up on it, I'm telling you. Thank you all for watching, and don't give up on this. Just get through this. Being an agent is not as hard as passing this test. Again, hit the like button, subscribe, and I'll see you on chapter 12.